Hello, everyone, and welcome back to Your Finance TV, the last show with Jay Pelosky for 2023. How are you, Jay?
Feel like it, Scott. It feels like the last show of the year. Maybe because last night was one of those holiday party filled nights. So a little slow on the uptake today.
Happens to all of us, Jay. That certainly does. All right, so I've got your musings here. I've had a quick overview of them. You talk about the confidence game, and listen, anyone in life knows that confidence is a big thing. If you don't have it, it's very hard to bounce back from it. But you're putting this towards the financial side of the world, and talk to us about the title confidence game.
Yeah, no, it came to me the other day. I was having breakfast with a good buddy of mine, a former Morgan Stanley colleague, and he said, "Look, the one thing people have to recognize and understand is that we are in a bull market for stocks, plain and simple." And it really struck me because I don't think most people would agree with that. I agree with it. We agree with it here at TPW Advisory. We've said for some time we felt that the low back in October of 2022 was the low. We also felt that the 2 quarters of negative GDP growth back early in 2022 was the recession that people continue to look forward to. We think it's already happened. And so it just struck me that to feel that you're in a bull market requires confidence. And if you look around, certainly one could argue that there's not many signs of confidence, right? If you look at consumer surveys, if you look at voting indications with all the polling going on about how people feel about the economy, how they feel about the president, notwithstanding, and here's the interesting thing, notwithstanding like the best jobs market in many, many decades, if not ever, notwithstanding the misery index being at one of the lowest levels in modern history when you take inflation and unemployment, combine the two, that's the famed misery index. It's actually suggesting this is one of the best periods for the U.S. In decades. And yet people don't feel that, right? They're not acting like that. And so this idea of confidence and the idea of investing as a confidence game, right? Because you have to be confident in the future, really just very basic. If you're not confident in the future, then you're not going to be buying stocks, right? Which are a bet on the future, which is a ticket for the future. And you may well be heavily in cash if you're not particularly confident. And for sure, you're not going to be in commodities, right? Because being in commodities means you got to be positive and confident about future economic activity. And so it really just all came kind of together, some of these thoughts, as we title this piece Musings because it's meant to be kind of what we're thinking about as we go through the week. And this week, touched on or kind of catalyzed by my breakfast with my buddy who's also in the business, full stop. People have to recognize we're in a bull market for stocks. And then that really kicks off the whole thinking and the idea around confidence and how investing is basically a confidence game.
Yeah, it's interesting. I was talking to a couple of CIOs this week and talking about the market and the end of the year, and they're like, "Oh, I can't wait for this year to be over." I'm like, "Well, hang on, people. Like the market's at all-time highs,
Yeah,
right? And
exactly.
like
It's
it's
S&P's up 20%.
yeah,
Global
and
equities are up 15, 16%.
and
Bonds
it
are
just
up.
doesn't
I
feel
mean,
like it to them.
yeah.
Yeah, and but like it also gets back to like another point you make in your musings this week about the old doomsters and dumpsters out there on the market and the scenario that potentially be coming up, and maybe that's what they're worried about potentially coming ahead. Like, are you getting tired of these doomsters and dumpsters?
Oh, for sure. I mean, as we've talked about, right, the evergreen recession call. People have been talking about recession for 2 years, and they refuse to give it up, even though every quarter comes through, economy's growing and doing fine. Companies' earnings are growing, right? We're done with the earnings recession. Q3 was the first quarter of year-over-year earnings growth, and in several quarters. So that's passed, but yeah, I make a point in the musings of noting how it's the year-end outlook season, You pick any one of them, there are dozens and dozens and dozens to pick from, and they're all filled with warnings about risks and doom and conflict and geopolitics and recession. I mean, it's interesting. One FinTwit example I saw collated 13 different Wall Street economists and their outlook for economic growth next year. Not a single one of them has economic acceleration, right? The consensus, Bloomberg consensus for GDP growth in the US next year, 1.2%. 1.2%. We're growing right now in Q4. The Atlanta Fed nowcast is about 2.7%. We're probably going to end up 2023 with a full year growth of somewhere around 3%. And so you have the consensus for economists of no acceleration. And in the stock market, it's the same thing. When you look at the strategist side, right? Wall Street top-down strategists, guess what? The combination of the leading firms, I think StoneX, I think they collated 19 different Wall Street firms, their forecasts for S&P at the end of 2024. 3%, 3% appreciation is the average. So clearly, when you talk about confidence and investing being a confidence game, and you look at those forecasts with not a single economist forecasting acceleration, the combination of all the brilliance and wisdom of Wall Street's 19 different strategists coming in with 3% growth for the S&P, 3% total return, or price, should say price, sorry. Price return for the S&P for 2024. Clearly, not a lot of confidence, right?
Yeah, it's interesting. Like you've been confident the whole way through, and like you highlighted the macro surprises that you had on the outlook for 2024. Like, has anything like obviously there's already been a couple of pieces of that change already. Where do you see any more surprises coming through there?
Yeah, no, I mean, we like to, we're big believers, as we've talked many times together, about having a framework and having a process, right? If you're going to do global macro investing, which is, opens you up to everything, it also means you could be completely confused, right? We talked about lean into complexity not too long ago. That was the title of one of our recent musings. And so 2 weeks ago, I think. And so, that's a big issue. And so for us, one of the things we did in our 2024 outlook, which has already now been out 7 weeks or so, is come up with 4 macro surprises, right? And we have seen, as you say, significant evidence of those surprises already manifesting. And the number one surprise was inflation focused, obviously, because that's the crux of the matter. And our surprise was that inflation was going to come in lower than expected, sooner than expected. And that clearly is manifested, right? The CPI print, the Federal Reserve validation, today's core PCE number coming in on a 6-month basis under 2%. The UK's inflation number coming in a couple of days ago, much lower than expected. Same thing for Europe, ex-UK. So this is a global issue, and that surprise number one is really manifesting. And then the other surprise that we continue to see bits and pieces of evidence is the return to macro stability, which was surprise number 3. And there the focus has been on the idea that we have been through an awful lot of tough conditions. We've gone through COVID. We've gone through the inflation spike, central bank rate spike, conflict in the Ukraine, now conflict in the Middle East, climate change. We've gone through a whole boatload of things, but that is now in the past. And going forward, we think we're entering a period of macro stability. And so the key there is what we call the $1 trillion reward unlock, right? Which we first wrote about now over 3 months ago. So it's really interesting to us how things that we talked about, we tend to be early, basically, right? We tend to be early and ahead of the curve. That doesn't make us always right, but it does make us, allow us to watch as people kind of come behind us and things that we talked about 3 months ago, a return to stability, now manifesting itself in terms of money coming off the sidelines. And so that $1 trillion unlock comes from the money market funds, which now hold on a global basis a staggering number, Scott, $8 trillion, $8 trillion in global money market funds, of which about 6 trillion are U.S. money market funds. And our whole point is that return to stability will unlock some of that money market fund inflows and have them reverse back out into risk assets. And we're seeing signs of that with some really big pops in inflows over the last week or two. And then there's one other that we should probably touch on, and that's the surprise number 4, which is the great debate between recession. Remember, I called it the evergreen recession call because people have been making it for coming up on 2 years, versus the early cycle call, right? And the idea that we're not late cycle going into recession, we're actually early cycle coming out into an economic recovery on a global basis. And we're in that camp. We're in that latter camp, the early cycle camp. And what's interesting is we're starting to see some examples there too.
Okay, well, let's touch on that early cycle activity that you talk about. Give us a couple examples.
Well, there's one that's in the home building segment, right? Home building is a key cycle driver. Very rarely do you have recession when home building is picking up, and we've seen, one of the things that's really interesting is how quickly the response is to economic data, right? So you have inflation peaking, and immediately interest rates peak and roll over, and you have a significant drop in mortgage rates, right? Mortgage rates were touching 8% for 30-year fixed rate mortgage. Now that's about 6.7%. What's the response? An immediate response in terms of mortgage applications really picking up. An immediate response in refi activity picking up, which puts money in people's pockets, allows people to consume, and sustains the economic growth pickup. And then you have the home starts, which, were a major surprise this week when they came out, much, much better than expected. And so that puts people to work building houses. Those people now have money to spend. And so that's a early cycle indicator. And then the second one, which really popped this week, is in the semiconductor space. And the little indicator to us was Micron. The semiconductor company, reported, and the CEO was on the tape talking about how he thinks the cycle has bottomed, that supply has improved, demand is picking up because of AI, and he thinks 2024 will be a good year, and 2025 will be a record year for semiconductor activity. So that semis are well known for being very early cycle, because nowadays, you have a chip in virtually everything, right? You buy a refrigerator, there are chips in it. You buy a car, there's tons of chips in it. You buy a phone, chips. You buy any kind of audio visual, chips. And so semis are very much an early cycle industry. And the fact that you have the big companies now talking about how the excess inventory that piled up during COVID has now been worked off. And this, by the way, is true across many industries, right? We've gone from inventory restocking to inventory destocking, and now we're about to start picking up. And that has big implications, in our view, for the manufacturing side of the global economy, which has been, definitely stagnant. And most PMIs, whether certainly U.S. manufacturing under 50, we would have thought it would have broken above 50 before the end of the year. That's been a view of ours for some time. Hasn't happened. But when we see data like the home building, like semis, even trucking starting to pick up, we note trucking that same situation, supply demand improving, that suggests to us that we are going to get that manufacturing recovery. It's just been a little bit delayed, given what's going on in the global economy.
Okay, so when we take all of this in, like, how is all of this impacting your portfolio? Like, is there any drastic changes happening to it?
Well, we haven't. Remember, we update once a month, and that was a couple weeks ago. And the point that we would be making on the portfolio is that the real segment of opportunity, as we see it, because remember, let's go back to our investment mantra in this period. Lower inflation leads to lower rates, which leads to a weaker dollar. Dollar down now under 102. It's 1015. It was at a high of 105, a month or two ago. And that leads to better performance outside the US. And there, our bet is on emerging markets, right? We're the most bullish we've been on EM in years. And then secondarily, it leads us to be bullish about commodities. And commodities are the one segment we wrote about this last week remember the title last week was Get Real, as in get real assets. And we continue to feel that really the opportunity set right now is in commodities because stocks have had a good run. Bonds, we think, have had a very good run. Actually, interesting to note as a quick aside that on the core PCE data report today, which was very good for inflation, bonds really didn't rally very much. And so that tells us that the bond rally has kind of run its course, at least for the near term. We would expect the 10-year to drift back towards 4%, for example. But here's an indicator that we really grabbed a hold of this week, which is from the Bank of America Fund Manager Survey, which is one of the great surveys on Wall Street. And the thing that caught our eye was that, and according to the institutions that they surveyed, folks are more overweight bonds and underweight commodities than at any point in the last 15 years. Okay, that's a real telling statistic, right? That suggests, again, going back to confidence game, that people are not really confident about the economic outlook. And so they're comfortable buying bonds. When they get comfortable with the economic outlook, they're going to buy commodities. And so we want to be a buyer of commodities. And we're again seeing the same kind of supply shut in and demand pickup, particularly in copper. That's becoming very visible in the copper market right now. I understand, or we've read that something like 3% of 2024 production has been taken out just in the last couple of weeks due to mine closures and subpar operating at several key copper mines. So when we look at oil, it's the same thing. We noted last week that the Dallas Fed break even for oil drillers is about $68 for WTI. And WTI last week was around $69, $70. So when you're at break even, there's not a lot of downside risk to the price, right? People are not going to do a lot when they're losing money by doing it. And so we look at that, we look at the copper market, we look at the oil market, and we see lots of opportunities in the commodity sector. And so, again, as people become more confident, as those 1.2% GDP forecasts for 24 get revised up, as those early cycle indicators, home builders, semis, trucking, manifest into a manufacturing recovery, commodities are going to do quite well. And so that's where we continue to pound the table, commodities and emerging markets. And both of those take confidence. And we, at least the TPW advisory, are confident that they're going to be a good place to be in 2024.
Well, I'm pretty confident you're going to enjoy the next couple of weeks off as well, Jay. So
that's probably the easiest bet of all, right? Yes, TPW advisory is going to be on vacation. I'm going to be on vacation, which I'm excited about. And so we will be back, hopefully with Your Finance TV and with another Friday Musings on January 12th. So until then, Scott, my friend, have a great holiday. I understand you're going to get your cast off and going to get a little bit more mobile here in the next week or two. So all best to you and your family, and have a wonderful Christmas holiday, and all best for 2024.
Well, thank you very much, Jane. Yes, the cast does come off. It's in my terms, a Boxing Day present on the 26th. But all the best to your family, and for all the viewers out there, you have a great holiday period as well. Until next time, good luck investing.